So I'm Nicholas Bornozis, president of Capital Inc., and I'm delighted to welcome Axel Siepmann, the managing director of Braemar Naves, who is going to give us a presentation on debt financing strategies available to the international and to the Chinese shipping community. Axel is going to take us through a variety of options, and I thank him for being with us and sharing his insight. Again, today's event is a global event, and we look forward to Axel's remarks and presentation. Thank you.
Yeah, Nicholas, thank you very much for the kind introduction and for the invitation to this presentation, and welcome everybody following this conference here. I'm next 15 minutes would like to give a very short introduction of what we do and then take you through different financing options available to ship owners. I myself, I've been in this business for 25 years now, founded Naves Corporate Finance, and we merged it into Braemar, one of the leading listed stock shipbroking firms, stock listed in London. So actually this company, Braemar Naves, emerged in 2017 out of the merger of an integrated shipbroking firm, and Naves Corporate Finance was actually founded in 2009 as a company focusing on helping financing solution, first of all in a restructuring environment, but over the years spreading across the globe, with today offices in Hamburg, London, Athens and Singapore, helping clients in all sorts of situations to raise financing on the debt side, on the equity side, in order to finance projects. The other subjects that we effectively work on are transaction advisory services. So we help people also to acquire entire businesses, selective assets. We've been focusing a lot on large debt portfolio transaction, which I will come back to in a second. And also restructuring services have been a core business since our foundation. The background of this presentation and why we believe it's actually quite a topical subject to talk about, it is that the access to bank financing gets extremely limited, especially in Europe. A number of banks have basically withdrawn from the market, downsized their portfolios, or have started a strategy where they really focus on selective core clients only, which leaves especially medium-sized ship owners with a not corporate structure in need to look at alternative financing solutions. The financing of new buildings has become more difficult, with basically financing during the building phases being partly unavailable. So it's really worthwhile to look at the options. On the other hand, we see an interesting development that other sources of financing have emerged. Since a number of years, Chinese leasing, of course, has become a very, very important player, but also credit funds and basically driven by private equity firms, by hedge funds, have seen a strong growth. And in a few seconds, I will give you a short overview of what is the current status on this. So we shall briefly examine a little bit what the market has been doing over the last few years. If we look towards the last 3 years, of course, bank financing in terms of volume continues to be the largest source of financing, but the trend is clearly it's downsizing, partly by repayment, partly by selling off large loan portfolios. And quite to the contrary, we've seen Chinese leasing companies and leasing companies in generally grabbing up a bigger market share year on year. And also the credit funds significantly expanding, primarily through acquisition of larger loan portfolios. If we look effectively at the breakdown here to the right, we see that there's only a selective number of banks that have expanded their portfolios over the last few years, but also a fair amount of banks with shrinking portfolios, whereas the Chinese leasing firms have experienced a steady growth Alternative financing is a rough estimate. I must highlight that. It's very hard to trace accurate numbers. We've tried to break this down by looking at deals that have been done over the last few years that have been public, in which we were partly involved. But the main driver of the expansion is really loan portfolio acquisitions of banks that partly sold billions in one transaction, and that were bought by these credit and hedge funds. If we look towards what are then ultimately the options to the various market participants, it's worthwhile to look at what different options are still in ship financing today. If we start at the large international banks, one can state that their lending policy happens to be actually quite restrictive, and they focus clearly on top-tier clients. Loan-to-value ratios tend to be, from the conservative side, 60%, but for top clients, 90% can be achieved. We've also, for really top-tier blue-chip clients, we've seen financings of 100%, but that is usually backed by really a large corporate structure, very strong employment figures, cargo. So a situation which, for, let's say, the overwhelming number of ship owners is hard to achieve. Margins can be extremely low. I beg pardon that I refrain a little bit from commenting on the precise levels during these presentations, but low meaning that it's really in the range that I would say start at around 100 basis points and then move slightly higher. The volume that they provide can sometimes be fairly large, even though the most largest transaction actually get placed through consortium deals. But it's an absolute essential requirement that that there is a corporate structure or a private banking angle, meaning that these clients have also a private banking relationship, have other assets with these banks, so that relationship and size are really very important drivers. The security concept is the very traditional one. It's recourse, it's corporate guarantees that are provided, and in so far that is familiar from what we've been observing in the market now for many years. Those banks have the tendency to focus on vessels that for sure shouldn't be older than 15 years old. But it includes new buildings. In some rare cases, of course, to corporate clients, pre-delivery financing is available, even though our observation is that happens to be the exception. And in terms of profile, I would say it usually stops at an 18-year profile. Tenors for banks are usually 2 to 10 years. There is, of course, as always, as on any of these criteria, there are exceptions. But also for banks, refinancing US dollars in the very long term gets increasingly expensive. So I would say the normal in today's market is probably somewhere between 5 and 7 years. Chinese leasing companies, especially in the new building environment, play a very important role, but they are also conservative in the way that they focus on corporate structures, core clients. They love listed businesses. Loan to values, we observe, are 70 to 90%. There have been cases potentially with higher figures, but they are relatively rare. Margins are also quite competitive. I would say probably a little higher than large international banks, and that's partly driven because these leasing companies do seek indeed refinancing from a lot of commercial banks as far as their own funding is concerned. But they can do extremely large volumes. They sometimes do. I mean, there's a variety of leasing companies. I would say the big companies love large deals, but there's also smaller leasing companies that then naturally focus on smaller transactions and that happen to support especially certain new building activities, as these leasing companies happen to be related also to the respective shipyards. The security concept is, of course, that they actually own the asset. That is something that, for example, certain European ship owners actually dislike. They like to be the owners themselves. So we see a little bit of a controversy in terms of structural requirement and on both ends. But usually the covenant is actually quite light. Age restrictions, I mean, as I said, leasing companies usually like young vessels. As always, there's a few exceptions. And in terms of profile, the interesting thing is it's also, I would say, can be 18 years, up to 18 years, but the tenor sometimes can actually be interesting. So we've seen structures up to 15 years, which is, of course, very, very supportive for ship owners and liner companies that would like to take a very, very long-term view. In that context, it's important to also mention basically the governmental export banks, which have been set up by the governments to support especially new building activities. They also sometimes can be quite aggressive on leverage. And of course, as these are government driven entities, they can be extremely competitive on the margin. On volume, they are flexible. But we find that they also clearly focus on, as other banks also do, on corporate structures. The distinguishing factor of these government export banks is that they partly can be involved in pre-delivery financing, which is a scare good to find in today's financing market. So that's really one of their strengths. And in terms of profile, I would say, yes, 15 years. We have heard of discussions with longer profiles, but the 15 years should basically serve as a rule of thumb looking at these. So these sources are relatively restricted, and most of the medium-sized ship owners, find it hard to qualify, except for they have a long-standing relationship to these banks, regard some of the core banks as their relationship banks. The rest of the market basically needs to look towards the other available sources. And there's still a number of niche specialized banks that really focus nearly exclusively on shipping. We find that they usually are more conservative on leverage. They are quite aware that they are niche banks, and they serve a clientele that basically wasn't able to secure financing with some of the larger banks. This is why they basically charge also slightly higher margins. The volume that you can find with these banks is also more limited. So they like smaller to medium-sized deals. And in terms of structural requirements, it's actually interesting. Some clearly favor and still require corporate structure, but some niche banks also do get involved in non-recourse structures and let's say also the traditional model ship financing. Some sort of guarantee is, of course, always highly appreciated, whether it's a corporate guarantee or partly a personal guarantee. But if the leverage is actually low, some of these banks actually can be there without a strong guarantee. In terms of vessel age restrictions and profiles and so forth, it's as typical as of any other banks. A peculiar situation are the Greek banks, who are actually quite active these days. For, let's say, most of our international viewers of this forum, the bad news is they really do focus on Greek clients. It's very much relationship driven. In terms of leverage, they also tend to be more on the conservative side. 70% is actually not very frequently observed. Margin level is medium by the sheer fact that they also need to find the US dollars and have to pay their prices. There are not too many natural deposits that they can collect. Deal volumes are more smaller, so we see them financing a ship or two, but for large transactions, that's not their core strengths. And insofar, I would say here worthwhile to notice for Greek owners, a great source. For the international owners, and then probably for this foreign, we can keep this rather brief. What has emerged over the last few years is an increasing number of other leasing companies, or I would say financing institutions that offer financing to the market via a lease structure. They clearly regard it as beneficial of taking ownership of the vessel, and they hope that in terms of trouble that puts them into a favorable position, that they do not have to go through a difficult fight in terms of non-performance of the counterparty. And insofar, they actually sometimes do dare to be aggressive. We've observed structures where loan to value wise up to 90% were provided. The margin level here is clearly more on the high side, as it's a dedicated product to catch those owners that couldn't find financing from any of the other sources I've already mentioned. Volume-wise, some of them have actually a deeper pocket. I wouldn't say that they can do extra large transactions, but it's a changing environment, and we see more and more players also with strong funding backgrounds entering the scene here. So the medium stated here, I would say, is an average. I wouldn't exclude that there's also one or the other player that can actually provide financing for the acquisition of entire fleets. There's no rule for real structural requirement other than that it's a lease, so the leasing company actually takes ownership of the asset. But on the other hand, if especially on higher leverage, there tends to be a complex accompanying package of different ratios in terms of covenants. Vessel age restriction, I would say most of the players favor vessels that are younger than 12 years, but there's also some niche players that have taken a specialty position to finance vintage tonnage, which can be 15 years of age or even older. So there's a few, depending on the international environment, there's a few players that have tax optimization schemes for their investors in the background, and they actually like old vessels that depreciate quickly down to scrap value. And therefore, naturally, in terms of profile, they can be extremely competitive. We've seen leasing companies offering profiles of more than 20 years. But on the tenor, we really see a limit up to 10 years. 10 years for most of them is actually already quite long-term money. Most of the structures happen to be shorter term. Last but not least, credit funds are, very interesting, basically market players. As I already mentioned, their strength has been buying loan portfolios, but certain players also went into the direct lending business. They can also be very aggressive, lending up to 90%, but the margin level is actually quite high. It's not rare to observe all-in financing costs of 9 to 12% on an annual basis. But in terms of volume, it can be anything. There's players that, likes financing vessel by vessel, small situations. And then there's players that say, they love situations, $250 million or even larger. So that is really a very, very broad spectrum with also new players, entering the market, basically, I would say, on a quarterly basis. You can't really say that there's a certain structural requirement. A lot of structures are tailor-made, and different funds have different structures. The good news is some people are actually focused on non-recourse structures. They really focus on the asset. Mind that some of them actually don't mind what we call a loan-to-own structure. So for them, providing a loan with a high coupon is also the starting point for becoming the vessel owner in 1 or 2 years' time. But that is clearly one needs to carefully distinguish, because there's also a variety of funds that do explicitly not want to take ownership if it can be avoided. And we've seen them basically participating in a situation that turned non-performing in actually quite a cooperative manner, avoiding to take ownership. But they tend to be very flexible, and insofar, I would say on most of the things, there's no rule, except that on tenor, they are shorter than the rest of the financing providers. So I would say 2 to 5 years is the norm. 7 years is actually the longer exception. Yeah, I mean, if we want to summarize it a little bit, I would say that, yeah, the traditional government-driven sources tend to be more restrictive in terms of lending policy. And then the more specialized it gets in terms of niche strategy from the capital provider side, the more it gets into taking risk at also higher margin. The less restrictive are the lending criteria. And the higher can be the loan to value, but it clearly comes along at a price. So as an owner that is basically, considering what his financing options are, I think the first careful assessment that you need to do is how can you structure your business and your project as to move it to the left side of the page, so meaning more towards the traditional financing sources. And the less options that you actually have and the more risk you also need to take, the more you end up basically to the right with innovative leasing companies and also with credit funds. So I would say if you look at bank financing, clearly the opportunity is that it can be extremely price competitive. It's interested in a long-term relationship, and the owner actually remains the owner. The downside is banks easily these days have concentration limits. The lending structures are increasingly restrictive, also partly driven by regulators becoming extremely tough with shipping banks. So there is unfortunately a very tough selection, core clients only. And this is why actually we see bank financing permanently declining in terms of market share in the lending space. Chinese leasing, anybody that doesn't mind basically somebody else owning a ship and that can actually get Chinese lease financing basically can take advantage of, attractive pricing, decent leverage, and also, you can find volume there. But the downside is not everybody qualifies. So if you don't have a corporate structure and you don't want to create a corporate structure, very hard to get it. And of course, it's a rigid scheme where you either you fit to the occasion or you simply just don't get it. I would also say you need a little bit more time in order to negotiate a deal with a Chinese leasing company, as they have a very formal and rigid investment process. That if you are under time pressure, you need to move extremely quick. Let's say in 4 weeks' time. In terms of timing, the process just doesn't fit to the financing need. That is clearly the strength of some credit funds. We've seen credit funds basically, from the first approach until paying out the money, it has been done in 4 weeks' time. They are used to work under time pressure. And insofar, in terms of acquisition financing, if you want to basically catch an opportunity where you need to move extremely fast and commit, this is why some people actually like to work with credit funds. They say, we don't mind taking expensive capital for 2 years. We appreciate the flexibility, the speed, and then basically they have 2 years time to go for, let's say, in terms of margin, a more attractive refinancing options. And they can actually build up structures that then would also fit to getting a different type and a cheaper financing in place. And so far, I would say that any of these structures has its certain merit, has its justification for being around. My conclusion on ship financing alternatives, there is lots of capital available. We shouldn't be afraid of especially debt financing, lease financing no longer being available to the shipping market. But we need to be prepared that there's different pockets that fit to a certain situation, and that there is risk-adjusted pricing more than probably 15 years ago. And insofar, food for thought. how to carefully select the best pocket that fits to ship owners' financing needs. Yeah, I would say that is very short summary here from our side. Of course, with Braemar Naves, we would love to support you in understanding, especially those more newer forms of financing, if you happen to tap into them. As I said, for example, there's some players that go for loan-to-own strategy. Maybe you would carefully want to avoid ending up financing with them. From the outside, sometimes hard to understand, but if you've worked, with some of them for a number of years, you can also help the owner to avoid a few pitfalls, also in the terms of how you negotiate the documentation with them. And in so far, I would say the optimistic piece of news from the financing front is financing is available, but make your homework prior to basically tapping into the market and make the best selection according to the structure that you can make available. Nicholas, that's it from my side. Thank you very much for the opportunity.
Well, thank you very much.